thousands of UK beginners are opening up shiny smartphone apps, dumping their hard-earned pounds into the S&P 500, and silently watching their hard-earned cash bleed out without even realizing it. They have been told by every internet guru that buying this legendary American index is a guaranteed golden ticket to easy wealth, but the brutal reality is that the vast majority of UK retail investors who buy the S&P 500 actually end up losing money, especially in their very first year. They are not losing because the American economy is crashing, but because they are stepping onto a financial battlefield completely blindfolded. They are getting utterly pulverized by invisible fees, currency swings, and aggressive tax traps designed to snatch their profits before they can even buy a pint. If you think your money is safe just because you bought a diversified index fund, you are in for a devastating shock. But here is the catch. When you buy the S&P 500 from the comfort of your UK home, you are not just investing in 500 of the biggest American companies. You are simultaneously making a massive, highly volatile bet on the global currency markets. Because the S&P 500 is priced in US dollars, but your bank account is loaded with British pounds. This means every single time you click that buy button, your platform has to convert your pounds into dollars. If the British pound suddenly strengthens against the dollar, the value of your US investments can plummet in UK terms, even if the actual stock market in New York is climbing upward. Imagine the S&P 500 index rises by a healthy 5%, but at the exact same time, the pound gains 6% against the dollar. Let me show you the math on this. If you invested £10,000 into an unhedged S&P 500 fund under those exact currency conditions, your investment pot would actually shrink, leaving you with less money than you started with, despite the US stock market technically going up. You are riding a giant currency seesaw, and most beginners have no idea which way it is tilting. But the currency fluctuation is only the first leak in your financial bucket. The next one is a deliberate, silent fee that your broker is desperately hoping you never notice. And this is where most people get caught out. Almost every single popular investment platform in the UK charges a hidden foreign exchange fee, often called an FX fee, whenever you buy or sell US-denominated assets. If your platform charges a 0.5% FX fee, that doesn't sound like a lot. But they slap that fee on your money when you buy, and then they slap it on your money again when you sell. If you are regularly trading, buying the dips, or moving money around, these tiny transaction paper cuts turn into a massive bleeding wound. If you deposit £1,000, £5 vanishes instantly on the way in, and another chunk vanishes on the way out, completely erasing your early gains before your shares have even had a chance to grow. But it gets worse. The taxman is hiding in the shadows, waiting to hand you a massive financial penalty if you do not set up your accounts correctly. If you buy the S&P 500 through a standard, taxable investment account instead of utilizing a tax-sheltered stocks and shares ISA, you are walking straight into a double taxation trap. First, the US government wants its cut. Because the companies in the S&P 500 pay dividends, the US Internal Revenue Service will automatically snatch a 30% withholding tax on those payments. You can slash this in half to 15% by electronically signing a digital document known as a W-8BEN form. But millions of UK beginners don't even know this form exists, meaning they are willingly donating 30% of their dividend income to the US government. Look at this exact number. If you have a growing investment pot of £20,000 yielding a 3% dividend, you should be receiving £600 a year. Without that signed form, the US government takes £180 of your cash straight off the top. And once that money finally crosses the Atlantic, HMRC is waiting at the border to slap you with UK dividend tax and capital gains tax if you have exceeded your agonizingly small annual tax-free allowances. By the time both governments have finished tearing apart your returns, your actual profit looks like a pile of dusty crumbs. The simple, legal shield to block this UK tax raid is to ensure every single penny you invest goes inside a stocks and shares ISA, where your capital gains and dividends are completely protected from HMRC's grasp, allowing your compound interest to grow in a fortified iron vault. But here is the catch. Even if you solve the tax problem, you still have to survive the psychological meat grinder of market volatility. Many beginners look at a historical chart of the S&P 500, see a smooth, upward-sloping line over 40 years, and assume it is a gentle escalator to wealth. It is not. It is a terrifying, stomach-churning roller coaster. The S&P 500 regularly experiences sharp drops of 10, 20, or even 30%. When the financial news headlines start screaming about an imminent economic apocalypse, panic spreads like wildfire. Beginners log into their investment apps, see their portfolio balance flashing bright red, and their primal instincts scream at them to stop the pain. They hit the panic sell button, transforming a temporary on-screen paper loss into a permanent, devastating, real-world loss of cold hard cash. Let me show you the math on this. If you invest £5,000 and the market drops by 20%, your screen shows £4,000. If you leave that money alone, history shows the market will eventually recover and climb to new heights. But if you panic and sell, you have officially flushed £1,000 down the drain. You then sit on the sidelines in cash, watching the market inevitably bounce back without you, leaving you poorer and deeply traumatized by the stock market. You must understand that volatility is simply the price of admission for long-term stock market gains. If you cannot look at a 20% drop in your portfolio without breaking into a cold sweat and reaching for the sell button, you should not be investing in index funds. And this is where most people get caught out. They don't realize that the modern S&P 500 is not actually a balanced, diversified reflection of the entire US economy. It is a market cap weighted index, which means the larger a company is, the bigger its share of the index. Today, the S&P 500 is incredibly top-heavy, dominated by a tiny handful of colossal technology giants. When you buy a standard S&P 500 index fund, you might think you are getting a beautifully balanced spread of retail, manufacturing, healthcare, and energy. But in reality, nearly a third of your entire investment is concentrated in just a few massive tech firms. If the technology sector experiences a sudden, brutal regulatory crackdown or a massive valuation bubble pops, the entire S&P 500 will drag your money down with it. Regardless of how well the other 493 companies are performing, you are essentially putting a massive portion of your eggs into a single, high-tech basket. But it gets worse. Beginners often fall victim to the wealth-destroying habit of tinkering. They cannot resist the urge to constantly check their app, adjust their allocations, or try to time the market by selling when they think the market is at a peak and planning to buy back in at the bottom. This active trading mindset is the absolute killer of compound interest. Every single transaction you make triggers spreads, potential fees, and forces you to compete against multi-billion-pound institutional algorithms. Study after study proves that even professional fund managers, with all their supercomputers and Ivy League degrees, fail to beat the simple strategy of buying and holding. By trying to be clever, you are actively sabotaging your own financial future. Look at this exact number. If you simply bought a low-cost, GBP-denominated S&P 500 index fund inside your stocks and shares ISA, set up an automatic monthly direct debit, deleted the app from your phone to avoid the temptation of looking at it, and did absolutely nothing for 15 years, you would statistically outperform over 90% of active investors. Wealth creation is not about frantic action. It is about aggressive patience and letting the compounding machine do the heavy lifting while you get on with your life. Stop letting currency fees, tax ignorance, and emotional panic drain your investment pot. The secret to winning the investing game is simply refusing to play the losing moves that trap everyone else. We are building real, unstoppable wealth together by mastering these hidden rules of the game. Stay smart and be money mad.